C3's IPO. This is the other one I want to talk about. And the reason I actually want to talk about this one, I think this is super interesting. Commodity risk in tech. This was my biggest as I was digging into their S1. It appears that, and you're a big proponent of this, and you've taught me this, revenue quality matters. But not only does revenue quality matter, they have huge exposure to oil and gas.
Mm-hmm.
How do you think about that as an investor, even in the private markets?
Yes. And by the way, great teardown. So we should go read that. Historically, oil and gas has been a great consumer of technology. Even when we were looking at companies we thought had big growth avenues in the renewable space, it's always good to see an anchor customers in oil and gas. They're good customers. The message I now deliver to our entire portfolio is you should expect, at best, flat account growth from your oil and gas customers. Mm-hmm. Every single budget is going under scrutiny. And there's just, the industry itself is collapsing or consolidating, and ancillary costs, unless they're directly associated with regulatory expense, are going to be cut.
Yeah, Baker Hughes made C3 rework their contract. So C3's revenues from last quarter to this quarter, and they do weird fiscal quarters, I think they do April or June, was down by about $2 million, which they attributed to Baker Hughes reworking their contract, which also, by the way, goes to the point of like when you have a strategic investor, you should be really aware of how much pull they actually have if they sit on the board.
So are they on the board?
I don't know if they're on the board, but they are pretty sizable cap table. Tom owns most of the voting stock. He owns like 80% of the voting stock. But I think this is another lesson from Clean Tech 1.0 is understanding where you have commodity exposure, even if you don't think you have commodity exposure. This is similar to like if you're a construction tech company, you're exposed to real estate, and maybe that one's more obvious, but it is something that you should be aware of if you're working in a space and you think you don't have a risk that you probably do.
Yeah. Yeah, I think that's a really good point. The other fun data point, I'd say, from that entire space is most of those contracts start out as like very asset specific to prove this. And the assets themselves, as we saw yesterday from Exxon, are being written down in an incredible fashion. And which when your project's value is tied to the asset value, you're in a lot of trouble. Like, so the commodity, whether you're tied to production or just tied to the asset, you're at the risk.
Yeah. That's, they've been on the flip side of that, they've been phenomenal at land and expand. Because once you figure out with one asset and those companies trust you with 1 or 2 or 5 assets, then it's really easy to roll you out to 100, right? I mean, that's kind of the business model. And digital twin follows this business model too, where you try one asset, you go into multiple assets. But I just thought it was interesting. And I think their IPO actually looks like a SPAC. Like and just in terms of the growth isn't that great. It's just, their revenues are not as high as I would have expected for an IPO, for a tech IPO. It's only in the 150 million-ish range. Some of these companies that have gone public at their stage are 750 to $1 billion in revenue. It feels a little bit early, but it feels like they know something's coming on the oil and gas side.
Yeah,
all speculatory.
So do you think they can make it up on renewables?
TBD, they list, I don't know their business other than what they listed on the S1. So like some of their key accounts were utilities, industrials. But if you read between the lines, there's heavy revenue concentration coming from somewhere. And I actually disagree with their point that there's no competition in this space. And that was pretty heavy in their S1, was that like, there's no competition coming from anyone from in the space. And actually, if you get into renewables, I actually disagree with that. But I also think like Uptake, Spark, there is competition in this space, in my opinion. I also think, and I'd be interested to get your opinion here, the companies that are leaders in this space to date, I think are leaders because they've consolidated talent and not necessarily, there's not a ton of machine learning and AI talent in the same way there hasn't been a lot of cybersecurity talent. And so if you can consolidate that technical talent into one entity, you can scale pretty quickly because your customers really need your service. I just think that changes really rapidly in no code AI, ML in the next 5 years.
Yeah. I think it's actually an incredible point. When a consultancy walks into a old school customer, the reason they still get to pay $400,000, $500,000 an hour, these consultants get paid, whether it's Accenture, Deloitte, McKinsey, whoever it is, because it's the brain talent that walks in and makes the customer say, "Oh, like yeah, these can pay for this incredible brain talent." And so I think you're right. Like a lot of these firms really are just consultancies with some technology attached to them, and they're getting paid because they've had the ability to harvest and attract talent. It's really important.
Yeah. Does that change in energy? I don't know, because technical talent hasn't traditionally been attracted to energy. So there's certainly the case that like that doesn't change in some industries. But I do think that in the same way that some of these things have become core competencies over time for every business, that it's possible that data science in general just becomes that way. But who knows?